Okay, so we wanted to put together a little bit of information on interest rates because obviously interest rates are very pertinent at the moment. We're starting to see pressure on them, and I wanted to probably explain where that pressure is coming from, but also the component parts and what we need to be looking at longer term versus getting around the short term noise. One of the things which does confuse people, so the Reserve Bank might come out each quarter and say, or each month and say, this is the cash rate. The cash rate is 0.1%. Now, that's what the Reserve Bank might be able to borrow money at, but for everyone on the street out there who's actually either investing in something or have got a mortgage, that's not what they're getting. Okay, so you're probably going to be paying somewhere between 3 and 4.5% as far as a variable rate for a mortgage. Investment loans will be slightly higher than that. Credit cards are about 21%. Never my recommendation. All right. If it makes you feel better, the cash rate in Venezuela has just dropped to 56%. As of 1 January, it was 58. So it's 56 now as of 1 March. So they're feeling a lot more pain than we are. But some of that cash rate, the reason we talk about cash rates is it's established based on the relative risk. So Venezuela, huge default risk. Therefore, if they want to get money, they've got to pay a massive amount. All right, so let's come back home, closer to home and talk about our rates. So I want to talk about our rates, but also why you're seeing a lot of volatility in share markets at the moment. All right, so first off, our rates. So the inflation rate came out today. So as at the 27th of April 2022, they've just announced that the CPI for the last quarter was a bit over 2, which gave us an annual rate of 5.1%. So if you look at that, we sort of look at that as the inflation rate of being 5.1%. So in the normal world, if your inflation rate's at 5.1, you expect interest rates to be 2 to 3% above that. And why do I say that? Well, if I was going to lend money to you, $100 to you, and I was only asking for a 2 or 3% return, and the inflation rate's actually 5, it means I'm going backwards every year by $2 to $3 in real purchasing power. Right? So why would I lend that money to you? If I said, okay, I want an interest rate of 7% and inflation's running at 5, then that's okay, because then I'm going, oh, well, that's all right, I'm still going to make a net 2% return. So that's the real rate of return over and above the inflation rate. Now, that sounds pretty scary. 7%, that would be pretty harsh. All right, we're not seeing those rates at the moment, and we're not trying to say you will. But inflation rates, the inflation rate running at the moment is indicative of some of the real underlying issues. So we'll take out the noise. The noise is supply chains. So supply chains are the limited number of items making it into our coastline at the moment. So the number of ships arriving from China, from India, from Taiwan, there's issues around microchips around the whole world at the moment. The cost of oil, there's a whole range of supply chain issues. In Australia, we've had floods, which has impacted on groceries. So all of those are transitory inflationary things. Now, some of those might be longer than we expected. So the supply chains may be staying there for a while, especially, unfortunately, if you look at China and their lockdowns, which includes Beijing and Shanghai, that will have a serious impact on some of those supply chains. But longer term, they are transitory. The one that isn't transitory, and the one that most economists look at as being a major, is the wages growth. So in Australia, we have very low levels of unemployment. I think it's currently 4%, but if you actually want to round it out to 3 decimal places, it's 3.957. So it's almost got a 3 in front of it. That's a very low level of unemployment. Go into a whole bunch of what's frictional and structural unemployment, but that's low for Australia, very low. And usually when I first did economics, I would have said that's actually a full employment. So if you're at full employment, we're all competing for resources. So a good quality applicant comes into this business. Now, how do we attract them? Look, we obviously offer a whole range of employee benefits, but also we're competing with other businesses who also want that good quality applicant. That means the price on that applicant rises. So that's wages growth, and it's been forced by scarcity. Once again, scarcity of human resources. So that's a real one. That's a real number sitting out there at the moment, and that it will be driving it up. The Reserve Bank and basically the government and the opposition are all coming down inflation. they think it will settle back to between 2 and 3%. But if it's 2 or 3%, you still need to get a real rate of return over and above that. So functionally, rates can sit at that 4 to 5, and that's probably what we're seeing into the future. And we then go, well, so why is that impacting on share markets? And frankly, it comes down to its earnings. So if you're invested in a company which has relatively high levels of debt, then it's going to be impacted by rising interest rates. And its investment loans are actually slightly higher than mortgage rates. So if it's impacted by earning rates, it's going to have a profit margin squeeze. Can it pass that on to consumers? Well, if consumers already have their own interest rate rises, fuel prices, grocery expenses, they're already discouraged to buy something. So they're going to be saying, I might just put that off. So if you raise the price on it, you're actually going to decrease my desire to buy that, or I might defer it, or I might save more before I get there. So it is actually very hard in high inflationary periods, even though you think it wouldn't be, but it is actually much harder to pass on those rate rises and the increased costs. So company profits will actually reduce. Now, company profits reduce, analysts look at them and go, well, I thought you were worth X in the old days, I now think you're worth Y because this is your new company profit. And so there's an ongoing bit of a spiral effect on that one. The point I would make, and it's a point, so we've had a few clients say, should I do that and should I do this? The truth is that if I can have this conversation with you, and then this conversation's been had all over every fund manager's stock room, on a daily basis the last 2 or 3 months. And yes, we've had that information as well. We've been talking about inflation since last December, and we've been talking interest rates right the way through the year. So that conversation's already had there. And what the market is always a forecaster. So the market talks about, if this information I'm sharing now has been around for a while, that's already factored into the price. So there isn't a scary thing about staying in the market because that information is already available. Yes, you've got to be careful of shocks. So Ukraine was a shock. If something happened in Taiwan, that would be a shock. All of those things. But historically, they're sort of pretty much transitory as well, and the market then settles down and goes back to looking at fundamentals. So what does that mean we're doing here at RFS? Obviously, we're taking account all these factors out there, and we do understand investment markets, we understand risk. If you're an existing client of our business, we've been talking to you about this already, you've been reading our blogs, you know that we're already thinking about how we can reduce risk in your portfolios, but also stay in that market because we don't necessarily want to totally jump out of a market because we may be wrong. Okay, there may be some positive aspects which we're not seeing. Russia might withdraw from Ukraine tomorrow. There's a whole range of things like that where you unexpected lifts and sitting out of the market mean you miss that bit of return. So if you've got concerns as an existing client, we always say, just come and talk to us. Right? There's things we can do, but also hopefully we're going to allay some of those fears. If you're a new client looking to have a foray into financial advice for the first time, why would you come to this business? Well, a lot of the stuff I've spoken about there is something we take into account every day. When someone comes into the business, we're not saying here tomorrow is the best day in the world to invest. We're always looking at what's happening in the market, but also we want you to be comfortable with the decisions you're making to move into that market. You want to understand the risk and you want to understand the opportunity. An important thing about this though is, there's always going to be noise. Right? So there's always going to be a lot of change going on. There's always volatility, there's always risk, there's always uncertainty. Right? Our job is really to help you get to where you want to go. And for a lot of people, it's actually, it's building a certain amount of money which will then deliver a lifestyle choice for them, lifestyle assets. There's a whole range of things like that, that's our job. So along the way, we can't get focused on what's happening in the next quarter. We want to focus on what's happening in the next 5 to 10 years for you. So that's the real core of the position you get when you come into this business. Right? We're going to help you get to where you want to be.